I'll make a brief introduction and then, as usual, take your questions. Since we met at the time of the spring meetings, economic growth has slowed further. We see a slowdown across Europe, but in particular in advanced Europe, and within that group, in particular in Germany and Italy, two countries with very large manufacturing sectors and export sectors. The UK has also underperformed due to Brexit-related uncertainties. In this context, we have lowered our forecast for 2019 marginally, not significantly, for advanced Europe from 1.4 to 1.3%. Emerging Europe has also seen a slowdown, but that is actually significantly less than we had expected, the slowdown in emerging Europe. And here we have therefore had to revise our forecast up a bit to 3.7%. So still relatively robust growth in emerging Europe. Now, what is driving that slowdown? It is still caused mainly by external trade, reflecting continued trade tension and other factors like Brexit. That said, there are signs of some incipient spillovers to domestic demand, notably to investment via confidence channels. On the other hand, domestic demand is still relatively robust, reflecting still very strong labor markets. In many labor markets, we have unemployment at or below pre-crisis level, and we still have relatively robust increases in wages. And credit growth remains strong on the back of supportive financial conditions. So, on the basis of this somewhat mixed picture, how do we see the outlook for 2020? For advanced Europe, we expect a modest recovery in growth, modest to 1.5%. For emerging markets, for emerging Europe, we do have a slight slowdown to 3.1%, still respectable. That reflects really the assumption of a lagged spillover from the slowdown in advanced Europe, and the fact that these countries have been growing quite strongly above potential, so there's sort of a convergence towards potential. Why are we projecting an upturn in emerging Europe? This reflects primarily the IMF's global assumption of a recovery in global demand, which obviously translate into a rebound in European export. In addition, as I said, labor markets are still strong, and we expect this to continue to underpin domestic demand. That, together with macroeconomic policies that continue to be supportive, not least monetary policy. That's the sort of the explanation for our assumption of a modest recovery in advanced Europe. Now, clearly, there are some risks to this forecast. The projected recovery is predicated on the assumption that we avoid a cliff edge Brexit and that there will be no further escalation of trade tension. Recent developments give some hope regarding the ability to avoid a cliff edge Brexit, but clearly we are still concerned about the risk of an escalation of trade tension. I would say overall, if you look at our forecast, risks are clearly on the downside. I want to put it differently, we are more likely next time around to have to revise downwards than upwards. Now, what are the policy implications of this? As I said, that we still have strong labor markets, and with the recovery, we still expect output gaps in many countries to be either closed or to be might have closed a bit from above, but we still have positive output gaps, and we are in a situation where we have, when it comes to fiscal policy, we are advising that fiscal policy should remain focused on medium-term objectives. This is what does that mean? That means that countries with high debt and limited fiscal space for their fiscal policy next year, in 2020, should still be guided by medium-term objectives. It is still the time for those countries to undertake fiscal consolidation. Countries with ample fiscal space, on the other hand, should undertake a measured fiscal expansion, use that fiscal space to take measures that would boost long-term growth, infrastructure, enhancing human capital, increase labor participation. This is not obviously a cyclical argument. It's a long-term structural argument. And as these are the countries often with the current account surpluses, large current account surpluses, this would certainly also help bring down external imbalances. Now, in view of the fact that the downside risks are significant, and in view of the fact that monetary policy, I'll get that to it in a second, is undoubtedly getting closer to the point where its effectiveness as a counter-cyclical tool might be limited, it is clearly critical that countries stand ready to deploy swiftly discretionary fiscal measures if downside risks materialize on a significant scale. So policymakers should have plans in their drawers that would allow them to rapidly deploy high-impact fiscal stimulus. It's critical that any discretionary fiscal relaxation, if it becomes needed, is implemented in the context of medium-term plans. Measures need to be well-focused and temporary, and they should strengthen confidence in medium-term fiscal targets. That's particularly important for countries with limited fiscal space if they are to avoid unsettling markets. A short remark on monetary policy. We are on monetary policy with inflation still stuck at low levels, have actually in advanced countries fallen a bit further. We remain of the view that monetary policy should be accommodative. We are supportive of the ECB's recent measures. As far as emerging Europe is concerned, we do think that they can hold on to the current monetary policy also for longer. Now, we are, of course, aware of concerns about the risks associated with that monetary policy. Clearly, low for longer means that one needs to be increasingly vigilant about such risk. We do not see them at this stage, and we still think that there might be some risk, local risk, if you want to put it like that. We think that is macro-prudential tools that are available are adequate to deal with such risk. But we do agree that these risks needs to be kept under close monitoring. Now, I think that's enough for short-term policies. Key issue is, again, despite the risk, despite the slowdown, we are not in a situation where we would recommend the deployment of discretionary fiscal measures at this stage. Now, looking to the medium term, while we have a recovery in our forecast, looking to the medium and long term, this is clearly a lackluster recovery. No doubt about that. We have a growth of about 1.5%. We are not looking to a return of the higher growth rate that we saw, until 2018. That is not in our forecast. This really reflects long-standing issues we have discussed before: aging, demographics, and low productivity. And that, of course, points to the urgency of structural reforms. We think still that this is an area where, in particular in advanced Europe, performance continue to be disappointing. Here, the needed reforms are often country-specific, so I will not get into details, but clearly the usual suspects are labor market reforms to increase flexibility in some countries, opening up a closed profession in other countries, strengthening, modernizing a solvency framework. The list is long. In emerging Europe, there clearly is also a need for structural reform. Now, emerging Europe, of course, this is the 30th anniversary of the beginning of the transition, and a very successful transition. Here the challenge is really to adopt what I would call second-generation reforms. The low-hanging fruits have been picked. The next generation of reform are often reforms of institutions to improve governance. It's more complicated, but clearly also emerging Europe facing complex set of structural reform challenges ahead. I'm going to stop here. Happy to take your questions.
Hi, hello. Jose de Haro from El Economista, Spain. 2 questions. Does the IMF has any number because of the impact that tariffs that the U.S. is implementing today to Europe because of the Airbus case, and the probability of that trade escalation with Europe increasing in the next couple of months? And then in the particular case of Spain, what's your recommendation since we are seeing again social unrest and we are going into new elections? What would you recommend to the next government of Spain?
Okay, on the Airbus thing. Now, this is of course we need to separate it from other trade. This is a long-running case. I think it's 15 years old. It is a case something that's being done inside the WTO framework. I think that the direct impact is limited. Now, it's in this fragile situation with a slowdown, it's certainly something one would have preferred to avoid. But I think that the key issue here is while it is separate from the other trade tension, I think it's important that we know that all parties are mindful of that. One needs to not to take actions that can escalate these trade tensions. So I think policymakers should bear that in mind. On Spain, let me just note that Spain has continued to perform better than Euro area partners, notably better. For a number of years, we have actually underestimated the strengths of the Spanish economy until recently, reflecting undoubtedly the reforms that were undertaken in the wake of the crisis. Spain has continued to do well despite some political uncertainties for a while, and we continue to think that Spain will it's not immune from the slowdown. There is a slowdown, but still Spain is among the countries that have continued to perform better, and I would expect that to continue. As far as the agenda of a new government, I think it's critical that one safeguards the reforms that have been done. There is a need to build on them. On further build the labour market reforms, and I think on the fiscal, clearly Spain benefited significantly from having much fiscal space at the beginning of 10 years ago, and the challenge is clearly to rebuild this fiscal space during the good years. These are still relatively good years, so Spain should continue with the fiscal consolidation. It's clearly one of the countries I have in mind when I say that fiscal objectives should be guided by medium-term objectives. In case of Spain, the medium-term objective is to bring down debt.
Alex, and is that on Brexit? Yeah. Can we a couple more questions on Brexit?
Yeah. So
wrap them.
I know it's early days yet, but after yesterday's agreement or outline agreement between the EU and Great Britain, I wonder if you had any thoughts on the impact that might have on European economies and I suppose the UK economy as well.
Any
no.
other? Okay. So, as you know, we do not have the details of that agreement. I take note of the sort of the objectives is to having something akin to a free trade agreement. That is, we'll have to see the detail. But what I've seen so far is fundamentally in line with what is the assumptions about Brexit in our baseline. Our baseline does not have a hard Brexit, does not have a cliff edge Brexit, and from that point of view, certainly this agreement is good news. That if it's supported, it would avoid one of the key risks that I mentioned before, and one of the key risks that I said sort of impart an overall downside risk to our outlook. So that would be good news if one could avoid that.
Thank you. Yaroslav Dolgopol, Ukrinform news agency, Ukraine. So my question is regarding Ukraine. The IMF has changed the forecast for Ukrainian GDP growth in 2019 from 2.7 in April to 3.0 in the latest World Economic Outlook, despite the elections here in the country and other reasons. So what are the reasons for the revision in a positive way for Ukraine? And the second question is regarding the program, the new program which is negotiated in Ukraine with IMF. Could you please add some details, for example, an amount, because the Ukrainian side said there is a program for the next 3 years, but no other details. Could you please just why this?
Sure, I'm happy to do so.
Mr. Paulson, thank you for doing this. Dmitry Anopchenko, Inter Television Channel, Chief US Correspondent. Sir, just a question about the main key points for the future cooperation with the Ukraine. What I heard, it was the importance of the independence of the national bank, because we got some issues here in Ukraine, the question of the private bank. So could you give a little bit more details? Question of the private bank, the biggest, the largest Ukrainian bank, which was given by the country according with the IMF recommendations.
Yeah, happy to give you on the first question of why we have revised growth upwards a bit. Its growth has proven to be a bit more robust, and we take that into account and revise our forecast. No, we do that the whole time. I think the important thing to keep in mind is that Ukraine has achieved a considerable measure of macroeconomic stability in recent years. I think the two programs, the EFF and the standby arrangement that followed, were quite successful in that regard. And I think that Ukraine is harvesting the benefit of that through some relatively good growth. Now, I say relatively in the circumstance because from a long-term perspective, Ukraine needs to do better, given the low level. Ukraine has a much bigger scope for catch-up than suggested by numbers like that. And the challenge is clearly structural reforms to unlock, and I'm not going to get into what the whole heap of these issues, but to undertake a broad set of structural reforms to increase productivity. Now, that leads to the other question on a program and what's in the program. There is a program in place right now. It's a relatively short standby arrangement. It was intended as a bridging operation to have something in place to help preserve the macroeconomic gains that we have achieved until the elections were over and a new government could be formed. The new government has said that it's interested in continuing relationship with the fund, but in line with the fact that Ukraine's main problems are long-term structural, it wants a 3-year EFF program, and that's what we are discussing. The amounts have not been discussed yet, so I cannot tell you anything on the amount. It's sincerely not been discussed yet. As far as the focus of this program is concerned, let me make 2 points. I think I started out by saying that Ukraine has achieved significant measure of macroeconomic stability. I think it's critical to preserve that. One of the key things is a tremendous change in the operation of the central bank, modernizing of the central bank, and including its independence. And we think it's absolutely critical that that is preserved, both regarding monetary policy, but not least also regarding financial sector supervision. That leads to the issue of Privat. Here, I think we think it's critical that the state continue its effort to try to limit the losses to the taxpayers from that resolution. So that is. That's clearly also an issue. Now, the second set of issues are indeed the structural reforms, the longer to broader structural reforms. Here there are a number of issues on the discussion. Land reforms are among them. Issues, as you know, that have been particularly important are issues to tackle corruption. And that is also still on the table. I think another issue that is important is the opening up of the economy. There's a lot of monopolistic structures in the economy, and that clearly is also something that is important. Here, we are in a dialogue with the government. Discussions, I think, are going well with Ukraine, and we intend to send a mission back out in a couple of weeks to continue to put the details on some of these reforms that I just mentioned.
Thank you, Leonard Giri with Greek TV. Do you think that Greece is on track to achieve their great goals and targets?
Sorry, could you say that again?
If you think that Greece is on track to achieve agreed goals and targets for in the medium term. Thank you.
Let me add a couple of questions that came online. How do you assess the Hercules plan for reducing the stock of non-performing loans from Greek banks that comes from Thanasis Koukakis? And according to the Fiscal Monitor, the Greek GDP will expand with a pace of 2.2%. The Greek Finance Ministry predicts 2.8%. Do you think that this forecast is far too optimistic? Coming from Georgos Papos from Star TV.
Okay, on the let's start with the questions regarding growth. In particular, the issue on the medium term. I think no, we have always said that Greece is in a difficult position. It's one of the on growth, long-term growth. It's one of the countries with the lowest productivity growth in the Eurozone, and it has particularly adverse demographics, which is why we had potential long-term growth assumption, I think below 1% actually. I cannot remember the exact number, but it was low. I think the key challenge is clearly to move Greece up into the up compared to other countries in terms of productivity. I think it is well known what the issues are there as far as broader structural reforms are concerned. I think it's critical that this is issues like opening up of the economy, of closed profession, of goods and service markets in general. There are a reform agenda here that is that was only partially achieved during the program period. As I've said before, I think Greece did very well in terms of labor market reforms, but not in terms of these broader reforms, and that is clearly the challenge facing Greece to do that. Secondly, we have said that while Greece has achieved a tremendous and impressive fiscal consolidation, it has been achieved in a way that is highly growth unfriendly by compressing capital spending and by cutting other current spending to levels where it, in our view, compromises the public sector's ability to provide basic services and to allow a much more growth-friendly fiscal policy mix. We think that it's critical that Greece undertake pension reform, and pensions are still very high, and the deficits are huge in the pension system. It's consuming a lot of scarce resources, and that Greece broadens its tax base. We are still in a situation where some 60% are exempt from, 50 to 60% are exempt from the personal income taxation. As I said before, Greece in some ways running a pension system common in the rest of Europe, while not doing the kind of middle class taxation that is common in the rest of Europe. These are challenges that needs to be resolved. From that perspective, we have always been disappointed that the pension reforms and the reforms to broaden the tax base were reversed when the program expired. I think that was a mistake that I hope can be rectified. So what I think that there's a whole set of issues out there that Greece needs to address in order to get long-term growth. I think that the new government is starting to do some of them. Some of the plans that are here, for instance, on privatization, I think are good. Bottom line is that the program has given Greece a breathing space, given Greece a considerable measure of macroeconomic and financial stability that will, together with a very favorable maturity structure of debt, means that Greece has the breathing space it needs to start gradually attacking doing these reforms that are needed to achieve long-term growth. So that was the long answer. The short answer: yes, Greece can achieve these ambitious growth targets, but that assumes very ambitious, structural reforms. Some of them are on the table, some of them are not yet on the table. Hercules. Sorry, I forgot Hercules. Hercules. We don't know. I don't think the Hercules is a program for that's being discussed for helping banks to reduce non-performing loans. We have not seen all the details. I don't think all the details are known yet. We agree that it's a critical challenge facing the Greek banking system to come up with a credible plan for reducing the exceptional high NPLs and improving the structure of capital, which is too much, contain too much depending on deferred tax assets. So we agree with the need to have a plan to do so, but whether this plan does it, we just need to we need to know the details, which we don't.
Please go ahead.
Phil Aldrich at the Times. As I came in, you were saying we would not recommend discretionary fiscal measures at this point. Just thinking about the UK in that context, if we diffuse the no-deal Brexit risk, would that recommendation apply to the UK as well, where the deficit is currently on track to be about up to 2.5% this year, and the Chancellor is planning further capital spending, borrowing to spend on capital?
So I would have to see the exact circumstances. I certainly would not. Certainly the UK has fiscal space. If it's exposed to a shock, and if a big negative shock, it has the fiscal space to undertake a discretionary fiscal relaxation if that is deemed desirable in the circumstances. But no, this is too abstract at this stage to. I need more information to judge what are the circumstances at the time.
Yes, here. I'll go to you, Luis.
Anton Paul, The Banker magazine. Do you believe the US-Ukraine crisis can impact the IMF support for the Ukraine, please?
I think that we remain focused on what's good for Ukraine. We have always done so. Once there is an agreement, I have no doubt that we will have full support from the international community on that. I don't see any impact on.
Luis Doncel from the Spanish newspaper El País. A follow-up question on the trade tensions between Europe and US. The European Commission has said today that there's no other chance than to respond to the American tariffs. You have just said that it's important for all the parties not to take actions that could escalate the conflict. Do you think, in that sense, that the European response goes in the bad direction?
So I am not gonna get into saying what should be done and should not be done. This is inside the WTO. You are referring to, right? You are referring to the ongoing discussions, also with Airbus, Boeing inside the WTO. That's. I welcome that these things are done in the context of the WTO. I just would say to everybody involved, that's important not to take measures, particularly in a situation where there are considerable trade tensions that goes beyond this set of issues, not to take measures that further aggravate the broader tensions. I am not going to comment on any individual decisions.
Larry Elliott of The Guardian. Just a couple of linked questions. One, I just wonder whether you think that, given the low level of, as you say, lackluster recovery in the in Europe, we've reaching the end of the road for monetary policy as a means of stimulating activity. And I'd just like your comments on, specifically on Italy, where bond yields have come down a lot. There's been, like all countries, it should have benefited from monetary stimulus, and yet growth remains very, very low in Italy. And I just wondered why you thought Italy had not benefited or seemed to benefit so little from the amount of monetary stimulus.
Your first question, can you repeat that?
Well, it was really, obviously the ECB has cut rates. They're negative, or some of them are negative. It's providing more quantitative easing. I just wonder whether you think generally we've reached or are reaching the end of the road for monetary policy in the Eurozone, whether we're pushing on a piece of string there or getting close to that.
Yeah, so No, I don't think that we are at the point where the monetary policy is ineffective, but I think we all agree that it is getting to the point where its effectiveness as a countercyclical tool will become increasingly limited, which is one of the reasons why I said that fiscal policymakers need to have the drawers in the plans in the drawers for how to react if there is a shock, because we have to realize that we are getting to a point where monetary policy is increasingly less effective. I don't think we are there now. But Italy, yes, Italy has had very low growth. Italy has had very low growth for a number of decades, actually, if you want to put it like that. Italy has a fundamental problem of low productivity, productivity improvements that fall short of its peers. There has, the last 20 years, has a gap in productivity relative to its euro area peers has opened up, and I think that's the key challenge. What to do about that? I think the issues are here also. We have talked about them many times. We think labor market reforms are clearly part of it. Opening up the economy, closed professions is another part of it. Modernizing the insolvency regime and the public administration is also part of it. And then, of course, Italy has a problem of fiscal of high debt, and it needs a credible plan for how to deal with this over the medium term, and it's critical that whatever it does in fiscal in the short run is anchored in a credible medium-term plan. And I know it's so clearly the low growth in Italy is not a question of monetary policy. It's a fundamental structural challenge.
Jeremy Warner, Daily Telegraph. Has Europe already done enough to ensure the sustainability of the euro in terms of institutional reform and crisis fighting mechanisms, or does it need to go somewhat further down the path of fiscal union to ensure the long-term sustainability of the currency?
So this is an area where a lot has been achieved, compared to 10 years ago on the eve of the Greek crisis. Now they have the fire brigade. They have a crisis. In terms of dealing with crisis, they have the ESM. The ECB has the OMT. They have the tools for how to deal with crisis. They have come a very long way on with the establishment of the SSM. And clearly, while we are not completed on the banking union, there is progress. Now, in terms of medium-term objective, we have made very clear what we think should be done. We think that there is a case for a countercyclical fiscal capacity. We think there's a need for complete banking union, to put in place deposit insurance with a common backstop. We think there is a case for simplifying the fiscal rules, and more recently we have put out a paper on that explain how we think one can get better integration of capital markets, build a capital market union. I think actually with this proposal we have more or less completed our contributions to the discussion on whether the European architecture need to go in the long term. Clearly, the progress on these issues are, as we have seen recently, a discussion on fiscal policy in particular. It's very slow. You know the issues, perennial debate between those who are concerned about that risk sharing will entail moral hazard problems. The bottom line is that risk reduction, risk sharing has to go hand in hand. I think all our proposal acknowledge that actually, and come up with proposals for how they can go hand in hand. And I hope that over time one would gradually converge to this. But clearly, Europe is, the euro area is well away from putting in place all these institutional reforms, changing the architecture, everything are needed over the medium term. Fundamentally, these changes are needed in order to sort of reduce the welfare cost of operating a currency union that has a common monetary policy, that is not a political union, that doesn't have a common fiscal policy, and where countries are exposed to country-specific shocks that cannot be mitigated to monetary policy, and the risk sharing will sort of help reduce the welfare cost of being in such a currency union. But let me say that you know, I don't like you linking it to what I think you say, use the word what the sustainability of I mean, you know, with or without the euro will survive, believe me. But clearly, in the long run, in order to enhance the welfare benefits of everybody, one needs these architectural reforms.
Okay, if there are no more questions, we'll wrap this briefing up. Thank you very much for coming, and have a good day.